All right, this is going to be a little bit of a brain dump. I know recently we've been talking about gold and silver in the near term, but I think we should also set our sights on the long term and the macro landscape as far as how it will impact gold and silver prices moving forward. Because in the very, very long term, I still think globalization will be a deflationary factor as far as prices are concerned. But I think we're seeing a little bit of an intermediary period that will last for years. Now, who knows how long this will last, but that will impact prices moving up in gold and silver. And if you take a look at just commodities in general, those prices should increase as well. Now, we are essentially talking about this minor, brief, transitory period of deglobalization. Now, this might be something you've been seeing from time to time, but yesterday, especially around the evening time, depending on when you saw this news, the Hang Seng in China, which is one of their major indices there, Hong Kong's Hang Seng index closes more than 4% down as China tech and education shares plunge. Now, you may wonder, well, what does this have to do with silver? What does this have to do with prices? Well, this is essentially a byproduct of this deglobalization that we're seeing. China is trying to keep its data within its borders. And recently, we've been seeing a lot of potential IPOs happening with some Chinese companies who want to be listed in American stock exchanges. Now, there's a fear here because when this happens, China may lose control a bit of its own companies. At the end of the day, China's China. And you might be asking, well, why is China attacking its own companies? Well, this is a part of my view here. But I'm just going to read a little bit of this article because I think it helps to illustrate my point a little bit more. Let me just try to move this over so you can see this a little bit better. Might be hard to see, so I'll just move this around for you. So, and I quote, "They're specifically targeting large tech companies that have gone to list on the US, like Alibaba, for instance. And while on the face of it, this makes no sense, you have to pay close attention to what China is up to. Sure, the likes of Didi bring in foreign currency and carry the Chinese flag with pride. But China doesn't need the money nor the validation. They need data. And they'll go to extreme lengths to protect their digital assets. Just look at what's happening around you. For the past few years, a data revolution of epic proportions has changed the way businesses think and function. Netflix wants to build a recommendation strategy for its millions of users. Uber wants to foresee demand using rider patterns. Google wants to create the most powerful chess engine that has ever existed. And as a consequence, you're constantly looking at developers building complicated models to glean insights from large data sets. Big companies training computers to solve problems using learning methods that mimic the human experience, and countries flush with cash trying to expedite this process. Didi and its ilk are part of this ecosystem. They've built products and services that collect and use vast amounts of user information. And while they've been very willing to share this data with state regulators in the past, China is skeptical about its intentions. After all, private companies still dance to their own beat. And once you go public in the US, maybe outside pressure will get to you. Maybe you'll succumb to US interests. China cannot let this happen. According to current projections, China is slated to hold almost a third of world's data by 2025, which is insane. I'm just going to jump to this last paragraph here. This gives them an enormous competitive advantage when it comes to advancing their interests in domains like artificial intelligence, big tech, and pretty much everything that drives the modern economy. China, though they are, it looks like they're, hamstringing themselves here in the short term. These guys are playing chess. They're not playing checkers. These guys, as we were saying in Baltimore, ain't for play. So this is really interesting to see, because as we're seeing this develop here in China, this is obviously bringing about talks of protectionism within China relative to other countries. And this brings us back to what happened a couple of years ago with the U.S. and China trade war. And during that time, we saw Mexico being pretty much a winner out of this. Check this out. U.S. and China got into a trade war and Mexico won. In 2019, Mexico became the largest trading partner with the U.S. And I think they're back to number 2 now. But during that time, the U.S. was starting to explore its options. And even currently, they're still number 2 now. At a certain point, they were number 3. So we're starting to look at reorienting our value chain. And again, that brings us back to the point of this video, which is increased prices. Because what you're starting to see here, in addition to China's protectionism, is also what it also brought about, the U.S. looking into moving things around the global value chain, is that China just simply is becoming a little bit too expensive for the United States. Now, this is from the World Bank. These are GDP deflators here. China or the United States is this one at the very bottom. China's the one in the middle, and Mexico's the one at the very top. Obviously, Mexico has a very high GDP deflator. Inflation is running a little bit hot in GDP terms. So GDP deflator is essentially nominal GDP over real GDP. And if nominal GDP is growing at a faster rate than real GDP, then that tells you that there's something going on with the price levels that are impacting nominal GDP. And as China is one of our largest trading partners, we're importing a little bit more inflation, or we may in the future, than what we would hope for. They have a higher GDP deflator, and their GDP is catching up to ours. So we need to start looking elsewhere. So obviously we start to look at Mexico. Though their rate is higher, their GDP is, lower. So it's not too much of an issue for us working with them. But in the near term, if China starts to grow even more, which they will by 2028, it's expected that they'll have the highest GDP in the world. Their GDP deflator is higher than ours. So at a certain point, we might start importing even more inflation. And for those of you who want to understand GDP deflators a little bit better, I have a quick highlight here. Simply put, the GDP price deflator shows how much a change in GDP relies on changes in the price level. It expresses the extent of price level changes or inflation within the economy by tracking the prices paid by businesses, the government, and consumers. So it's a way of taking a look at internal, domestic, not imported inflation. So going back to the point of our video here, which is a medium-term deglobalization that we're starting to see because of reorienting of value chains. China and the U.S. may stop working as closely as they were, and because of that, the United States will have to look elsewhere to get their business or distribute their business amongst other countries, and not just have it heavily concentrated with China. And because of that, there might be increased prices. Take a look at what this article had to say here from the Heinrich Foundation. Third, the reorientation of global value chains will accelerate. Western multinationals will relocate parts of their production from China to other countries on cost grounds, as they have been doing, but increasingly on political risk and security grounds as well. Again, this is kind of what we've been talking a little bit about when it comes to data. There will be a combination of onshoring, so maybe more jobs here, nearshoring, which might be, hey, we got some partners nearby, and regionalization of value chains. So, we have our partners to the north, Canada, we have our partners to the south, Mexico, which will vary widely by sector. But the overall effect will be to raise costs for producers and consumers. And this is what I'm talking about relative to prices for silver and gold increasing. Because as the CPI increases, we know that there's a positive relationship between CPI going up and gold and silver prices going up as well. Now, here we have the global value chain participation over time, because you may be thinking, well, this isn't happening. Are global value chain still intact? Well, take a look at this. This is from the World Development Report from 2020. Actually, since the mid 2000s, global value chain participation has actually been on a decline. And we were on an incline for some time, but we've actually been on a bit of a decline. So take a look at this highlight here. After the Great Recession, the pace of value chain participation stagnated. Some explanations include the rise in automation as a substitute for outsourcing, which will be a deflationary factor, but increases in labor costs in developing countries. So we're starting to see increases in labor costs in China, and technological wars and the subsequent protectionist measures implemented by some governments, which is what we see coming from China. Pretty much at the start of this video, I talked about what the Hang Seng was doing in response to China having a tighter grip on their tech sector. And here we have some more talk about global value chains and increased costs and shipping, which we may see, protectionist measures, which will also increase costs because of the moving of the value chains, global lockdowns, things happening unilaterally as well. Some people saying, hey, we're not going to support, or hey, we're going to shut down over here. That might be a place where people are getting products or where products are being manufactured. So, for example, here, the case of rare earth metals from China used in production of semiconductors. Obviously, we know what's going on with that. So all of these shifts are happening to the point of distorting globalization in the long term. Now, I still think globalization will be something that we're going to continue to see. I don't think we're just going to, retrench and it's going to be an every man for himself with countries. But I do think we're starting to see a little bit of a hiccup in globalization right now, where we're starting to see some changes in global value chains as people start to reassess cost and people start to reassess their own domestic goals, which may bring about a level of protectionism. But I think after that occurs and starts to settle, and that dust starts to settle, I think we're going to go back to a general globalization. And I think that another thing that we just need to also just keep in mind that's deflationary is automation. That's another part of the story. At a certain point, we might have automation take control or reduce some of these costs as tech gets a little bit better. So guys, let me know what you think about this, the impact of prices increasing on silver and gold in the long run. I know this is more of a macro view, but you guys know that's what I like to do. That's what I like to look at to see how it might play as far as prices in the long term. So let me know what you think in the comment section below. Thanks again for watching.